So there's a comment saying, when will you start? I have the next session at 11. So do I. I'll meet you at 11. Yeah, we'll start in about 2 minutes or so. Just waiting for more people to join, and then they'll give me the go ahead for to start. I won't take much of your time. We'll have a very interesting Q&A like always. The topic for this week, this is a topic that we have done called Beyond ESOPs. So basically, we'll look at how you are actually getting taxed on ESOPs. How your current employer, your or your stock purchase plan is actually structured, what you can do with it, and how you're running this risk of concentration, right? So we'll get into all of it. Just give us a couple of more minutes and then we'll start. I won't take much time, don't worry. Okay, so let's dive in. So the early bird gets the worm. Early believers in a company's success story are the ones who actually benefit the most over a long period of time. Yes, you stick with the current company for a long period of time, your responsibilities grow. You start growing there. You get into more leadership positions, and naturally, when you look back, yes, you are one of the early birds, right? So let's look at a story. Let's look at a normal case, right? So Vijay started his tech career in one of the most leading IT services of India, and this is what most people start off with. They start off majorly with IT, and as uh, as your role sort of develops, is then when you start getting in ESOPs and RSUs, and after some time you actually go and start looking out for jobs. So naturally you will look out for a new challenge, and then the next part of story is that yes, you will go to a US based tech company that has some operations and has some base in India, where their compensation is majorly stock options and RSUs, right? So that salary is about 10% lower than what he was currently drawing, and they had ESOPs and RSUs, and the year-end cash bonus was up to 20% of the annual income, right? So they can also participate. He could also participate in the company's stock purchase plan, right? So now, does this actually lead to a wealth creation? Now, that's the question that we need to ask, because if he had a clear understanding of his deliverables, he could earn his 20% bonus. And the stock purchase plan was structured so that he would make an immediate 10% return on his investment. Right? Immediate 10% return, which again would be taxed. Right? So every year, a portion of his RSUs would vest, creating an additional stream of income, which again is going to be sort of taxed. Right? So tax planning is very, very important when you look at ESOPs, right? Because you're going to make an upfront 10% on your investment straight up, right? And every year, whatever portion of your RSU that you vest, which is creating an additional stream of income for you, is getting taxed on your slab rate, right? Because it's treated as income, right? So all of it is just under one basket, right? So the wealth creation is completely dependent entirely on how the company performs, right? So your salary, your bonus, main thing, if it's listed, yes, that stock price is what is determining your wealth creation journey. Now, I remember in 2021, employers from Meta, once Meta crashed, moved to another place because their stock options were then priced very, very low. So their compensations again were very, very low. So it is just a hop from one place to the other place to the other place, hoping to make the most out of compensations, right? So there is no stability in that. You're just moving from one place to the other place to get compensated a little bit more based on your stock price. So decisions are not being taken on how the company performs. Decisions are now being taken on how the stock price is performing, right? So everybody is now moving to that stock price performance thing and not based on company fundamentals, right? So it's entirely dependent on how the company is sort of performing, right? And you will obviously see many shifts taking place from one tech company to the other tech company. You would have heard also in your entire circle, right? So let RSUs, all you need to know, only own RSUs on vesting, right? This reduces your career mobility. You can't shift more, right? There's no guaranteed return, right? There is concentration risk as and when you start getting more, vesting more RSUs, right? Main thing is it is taxed as income when you vest it, right? Likewise, even your ESOP, right? It has an option to buy the stock. There are two levels of tax. When you get it, you're obviously getting it at a discount. So that difference is what you're taxed on. Second, the capital gains that you do, I mean, the capital gains that you make is also sort of taxed. So it's one is the slab tax rate, which is the difference between the fair price and the excise price that you got it at, and your capital gains. So there's two levels of tax that it comes to when it comes to ESOP. Right. So when does it make sense, your stock purchase plan? The 10% gain only works when you sell immediately, right? Right. There are better returns at a cyclical low. This is the best because let's say that employee at Meta, when he was shifting, when the price was low, actually at that point of time, as more and more people come in, for a job at Meta, then they start getting more and more RSUs and ESOPs at that price. Naturally, you're going to make a lot more. So it's better returns at cyclical lows. You start making much more when there's a bottom sort of forming up in the entire market, right? Accumulation and decumulation should happen. So basically, you should accumulate as and when you get that opportunity, when you feel that yes, company fundamentals are improving, but stock prices do not reflect it. And likewise, second, when company fundamentals have deteriorated, right? But there's no reaction to sort of stock price. There's a dichotomy in terms of fundamentals and the stock price. That's when you should start taking advantage of it. That's when it makes sense, right? That's when your ESOP is actually starting to work for you, right? But these are the three main things of when it makes sense for you to participate in a stock purchase plan, right? Now, this is what we were talking about. This is a slide that is there on all presentations, which is a very, very important slide because it says market cycles, right? And it's very important for you to understand how market cycles work because at a time when things are very bad, there will be a lot of fear. You will be disappointed and you will want to go to a part or go to a point or go to a company where they're doing a lot more better than what your current employers is doing, right? So it's just like how the market cycles work. When there is a lot of fear, they say, you know what, you should be selling or you should be holding it, don't worry about it. And when there's extreme confidence, when the price starts going up, is when you start saying, yes, I want to buy. So for example, PayPal was somewhere at the 300 range when a lot of bullishness came within the employees, right? And that's when a lot of people went and started to accumulate on that part, seeing that particular conference. And today PayPal price is somewhere between $63, right? So there's a huge drop in your compensation level. So you have no choice but to hold, and you can't, move out of another place because then you're not being compensated for the actual work that you've done, right? So always be in this stage to accumulate and to decumulate. So basically keep some off the table, right? So when there's fear, that's when you should actually flip it. That's when you should actually start accumulating a lot more. And when you see that there's a lot of overconfidence in the market coming up, there's a lot of overconfidence within the company, there's a lot of change in fundamentals also coming in and starting to come into place. That's when you should rethink your current strategy of your compensation, right? Now, stock price and business fundamentals is very important for you to know that there will be some form of short-term divergence coming in, but in the long term, things will converge. Things will converge to what the fair value of the business and what the company is, right? So, like I said, when the tech boom happened and when the tech bust happened, right within that entire 1 year, is when you saw a lot of shift taking place. But today, when you see, you can't do without those particular companies. They're quite large. They are the ones that are spending on AI capex. So you can't do without these companies, right? So there was a lot of short-term divergence across the entire industry. But from a long-term perspective, you see that there are players that are becoming huge monopolies where in the long term, you already are able to see visible signs that yes, there will be a lot of convergence taking place. So always remember that you will always find some form of short-term fluctuations, but in the long term, things usually play out. If it's a great company, things usually will play out at its own pace. And if you see, there have been many wealth creators in India. If you look at Indian tech also, over a long period of time, it has been a wealth creator, right? So long term, things will start to converge. Now let's look at the tax impact. Now in RSU during vesting, the market value of the shares at the time of vesting is considered as income and is taxed accordingly, right? So this is changed for you know the new budget norms. So your short term will be 20%, your long term will be 12.5% on your gains above 1.25 lakhs, right? For global, your long term is considered as 2-year plus, right? Which is a good thing, because back before the change in tax norms, it was 20% with indexation. Now it's just 12.5%. So it makes it a lot more simpler in terms of tax. So you don't have to worry too much about uh, taxes now, because it's all same, it's all similar, no indexation, nothing, it's all very similar. But you need to make sure that you need to understand that yes, in ESOP during exercise, the difference between the fair value and the exercise is taxed at your slab rate, right? So that's the only part that you sort of need to remember, and there are two taxes on ESOP, right? So the tax impact has become a lot more simpler, but it's important for you to know that RSUs and ESOPs are taxed this way, right? This is an example of where we had reviewed an ESOP. We don't want to mention the name, but we have put the price chart out. So we had began reviewing here, and there was a good amount of profit booking that came in as things start to do extremely well. The whole point of this is that there were valuation risks, and at that point of time you have to take the call to sort of step back, manage your concentration risk, and diversify your investment. The whole point of making sure that your ESOP actually becomes your basket for retirement is diversifying from that particular concentration risk, because that concentration risk over a long period of time becomes very large, right? So de-risking for wealth creation is the journey for you when you have to think of your ESOP and how that can become a basket for your retirement, right? So yeah, so you're seeing that there was a lot of profit booking that actually took place, and that started to get diversified into other asset classes, into other avenues, where again that becomes your basket for wealth creation and for your retirement, right? So all fortune is good fortune, for it either rewards discipline, amends, or punishes, and so is either useful or just, right? So all fortune is good fortune. So how should fortune favor Vijay? Look, your reward that comes in is your ESOP, your RSU, your stock purchase plan. Your discipline is asset allocation. Main thing here is that you need to be very disciplined, and you need to plan for where you need to take that money off, diversify to make sure that there's no concentration risk. Because like for example, Intel yesterday dropped 30%. So 30% of wealth just gone off on one day. Second, Snapchat. These are all very large, very big tech companies. You already know about these companies. Snapchat lost 1/3 of its entire company value yesterday. 1/3 of its entire company value. So you can imagine the employees there whose compensation is again linked to the stock price. Right, entire company value gone out. 1/3 of the entire company gone, wiped off on one single day. Right, so you are running that sort of concentration risk, which you should be aware of. Hence, sort of have a plan for asset allocation. So strategic financial planning is what you need to look at. Goal-based asset mapping is what you need to look at. Prioritizing your goal is what you need to be looking at. And main thing is, how do you rebalance over a long period of time? See, in the US, there's a 401k that does rebalancing by itself when you choose target retirement dated option, right? So they do it by themselves without checking or without assessing for what goal you're doing it for, or what your priorities are. It's just based on your particular age. Say yes, you want to retire by 2050. So 5 years before that, they will, or 6 years before that, they will start putting more and more assets into US Treasury, and they would automatically do it, irrespective of where you are in stages, irrespective of where the market is, irrespective of how things are going to play out. Nothing. If it's at a low, yes, you're still 5 years away, 6 years away from retirement. That doesn't matter. It's an automatic shift. But here you have to rebalance. Rebalancing has to be extremely tailor-made for you, tailor-made for your goals, because we have to prioritize those goals. We cannot prioritize just based on a particular age. We have to prioritize based on whatever goals is coming up for you. And even that rebalancing needs to be tailor-made as per your risk profile. Right. So multi-asset investing is one very good solution that can help you diversify from that concentration risk, at the same time manage your asset allocation, your rebalancing, at the same time create that discipline for you when it comes to saving money, right? So this way you have the option to save every month into this investment vehicle. Drawdowns are lower because we are taking care of rebalancing. We are taking care of how much money needs to be in a particular asset classes. It helps you compound regularly and consistently, right? Without much volatility, without seeing such 1/3 of the company value go off, without seeing such losses, is where you can compound regularly and consistently. And we are building asset classes. We are building money into asset classes and businesses at the right time, at the right places, right? So there's a lateral shift that takes place, ensuring that yes, it is as per your goal, it is as per whatever priority is coming up in the future for you, right? So the determining factor is majorly asset allocation. So this was a very good study that we did. Market timing has no role to play when it comes to how portfolio returns do come in. It has everything to do with asset allocation, where there's a very small portion where you can choose a particular security, where that actually makes it much more better. But asset allocation is the main determinant of portfolio returns, right? So why does it work? It works because it suits a wider range of risk profiles, just like target dated retirement funds in the US for 401k. They have multiple dates. Here we work with multiple risk profiles, right? The point is that somebody else might have very high risk appetite, but their goals might not be very long. So it might be very short-term goal. So short-term strategy for them would need to be taking place, right? This is not to say that they cannot or they should not be taking risks, but yeah, they have the ability to take risks, they have the willingness to take risks, but the goal does not require you to take that particular risk. So everything is tailor-made, so it suits a wider range of risk profiles, right? It exceeds moderate return expectations. See, when you look at return expectations in India, it is somewhere majorly between 9 and 12%. That's what history has actually gone and delivered. 9 and 12% is a very base case when you talk about investing in India, right? So multi-asset investing, because you're able to take advantage of cycles that come in within asset classes, you are able to exceed that moderate return because you're able to take advantage of equity at the right time, because you're able to take advantage of debt at the right time, because you're able to take advantage of precious metals at the right time. So this way you're able to participate continuously, right? You're not sticking your neck out for one particular asset class. You're not sticking your neck out for one particular company. You're not sticking your neck out anywhere. So that cuts the entire risk of concentration and it allows investors to participate continuously across asset classes, right? So making multi-asset work for you, basically you have to be very conscious of valuations, what you pay for that particular business. Being contrarian, staying away from the crowd actually makes a lot of so for example, now everybody is going towards equity. Last 3 days or 4 days in the week, you saw that the Japanese central bank raised the interest rates, the yen started to appreciate to the dollar, and you see all hell break loose because last 2 days you saw US market also so source of capital, that is Japan, is now becoming an expensive source of capital. So naturally it's affecting the largest developed nation in the world, right? So in those cases, when you know that there's a lot of macro fundamental issue where inflations are high, interest rates are high, staying away from the crowd, being contrarian actually works. So rather than having more of it on the equity side, you need to have some part on the debt side, take advantage on the debt side. And that's what you can do when you stay away from the crowd. You're being contrarian, right? And being patient. So contrarianism always requires you to have a high level of patience and a high level of discipline. So good things come to those who actually go and wait. Right. And sticking on account for one asset class definitely is not going to work for you, because there are periods like now where you will see a lot of problems coming in on equity as an asset class. Right. So naturally, you need to have money parked in all the other asset classes so you can take advantage of wherever there is mispricing. The point is that take advantage of mispricing, you will obviously make better returns in the future. Right. So let's look at Sphere. These are a couple of testimonials of investors who we have worked with for building their retirement nest. So it's there on our website also, so you can check them out. You can check what they've written, and if you have some thoughts to share, please do share it in the comment box. If you look at how Sphere has done compared to dynamic asset mutual funds and flexicap mutual funds, we've done fairly better than them. If you look at the last 3 months and the 6 months, this is slightly dated. The last 1 year, 2 year also, since our inception also, we've done fairly better. This is by taking lower risk. This is by having a multi-asset approach. This is by making sure it's all tailor-made. Right? So this is as a house. So if you look at how Sphere handles drawdowns, Sphere drawdowns have been much lesser than a pure 100% equity product. Naturally, it will be much more lower than your ESOP and your RSU, because you will go through, as markets start becoming much more volatile, you will see a lot more problems coming in with your compensation. And compared to the multi-asset, it's about 8%. Right. Minimum investment 50 lakhs. There's a fixed fee of 1.5% per annum. Main thing is that it's not, we don't have a particular cap on an asset class. We can go 0 to 100 in any asset class. Right. That way, wherever there is mispricing to be taken advantage of, we will take care of that. And within equity, let's say if there's global that we can take advantage of, we will. Within that, there's domestic. We will. Within domestic, we have a basket approach. We will take the basket approach. Right. Within precious metals, if there's gold, silver, whatever precious metal that we can take advantage of, we can. Right. It's a fixed fee, 1.5% per annum is a fixed fee. Right. So if you look at the returns since inception, we have done somewhere around 24.5%. Main thing is you look at from a house perspective, the fund currently has a 76% exposure towards equity, 10% towards precious metals. Cash is about 2%. Global is about 9%. Debt is about 4%. Right. But day one deployment. So for example, if you do start coming in on board, our day one deployment itself is somewhere between 37 to 40%. So we don't commit to money unless and until there's an opportunity for us to invest in. And within that opportunity for us to invest in, major overweights are on debt and precious metals and not on equity. Right. So this number is legacy, which is as a house, but newer assets that are getting built are majorly towards opportunistic assets like precious metals, debt, and only then sort of comes equity. So we are able to take care of that rebalancing and asset allocation as well for you. Right. This is the team. If you look at our research and strategy team, it's a very strong rooster. We have a lot of experience in the team, and we have all been there here for more than 6-7 years. In the fund management team, you have Balaji sir, who is our head of research and the co-fund manager of our large cap fund. You have Rohit and Rajat, who are who manage the small cap fund, and you have Niranjan Sridhar, which is who is the head of investment strategy, who is also part of the Sphere team, and he co-manages also the Sphere fund. Everything comes under Shamsar's basket. He's the CIO, he's the fund manager, so no call gets taken without him. He's the fund manager, so he takes the call. But we have a very strong roster of research and strategy that work closely to build each and every single portfolio. Right. Now I think we'll open the floor for Q&A. Like I said, I won't take much time. So now we can have a good fruitful Q&A as well. So I'll put the number here, and if I missed out on anything, please please reach out. I might have missed. So if you want anything, if you want me to go through a particular slide, I'll go through. Tax, you said yes, I'll just take you there. So don't worry. Basic question is how many days ESOPs are offered. Many IT companies extra, but most manufacturing don't. As ITES alone get such. In fact, it's all related to tech companies alone. It may be a small percentage of India who work in IT, but majority is manufacturing and other sectors, such as ESOPs are not part of CTC. See, as yeah, you're right. It's majorly a behavior of the tech industry, but you need to be aware as things start to get much more better. You will see a lot more growth coming in on all industries and all sectors. So when this becomes a part of your compensation, you need to be aware. That's it. How capital gains are handled when booking profits with ESOPs. Here, I'll just show you that slide. You can take a screenshot of it. You can take a screenshot of it, no problem. Just give me a thumbs up if you're if you're happy with the chart, or if you want some improvement, we can go back also and do something. Yeah, basically now assets are all similar long term only. That's very good actually, because when you look at global, it was all 20% with indexation. It was a headache actually. Now it's very similar. It's very same. That's very good actually. Gold funds, fund of funds also same only. Your equity funds also are 12.5%. See, earlier it was at slab rate. Gold, silver ETF also before they were at slab rate. Now it is 12.5%. Overseas fund of fund also at slab rate. Now it is 12.5%. Gold funds also they were at slab rate. Now it's 12.5%. So it evens. Yeah, even for real estate, everything is even. Everything is even Steven. That's very good. Yeah, holding period only differs. That's it. Overseas and global is 24 months. That's it. So it's all sorted. Then why most crib? I don't know why most crib. Do you have an option for investing in the US and Japanese stock market from India? Yeah, we have ETFs that we invest in the US market and the Japanese market. Japanese market is on a tear. So based on our risk profile, US market is going through some recessionary issues. So again, as per your risk appetite. Global stocks, RSU are all that are, yeah, everything that is global in nature, that 24 months is considered as, so that is 2 years beyond is considered as long term. Below that is short term. Now, equity, real estate, gold all become equal, but equity holds the highest risk, so that makes difficult to stay aggressive. I would say real estate is the most aggressive because it's not liquid. Equity is liquid. You can exit whenever you want to. On real estate, you need somebody on the other side to take up your property. And then there's so many laws. There's a lot of costs involved. It's a little tedious. So I would say real estate is the most riskiest asset. Equity is 15 minutes it takes for you to open your account, whether it is with us on mutual funds, whether it is that is if you are very proactive, and your KYC is actually validated. So it takes if you go on to grow zero that it'll take 15-20 minutes. So that's one. Second, so you have ease of access basically. Second, everything is liquid, so you can exit whenever you want to, you can enter whenever you want to. So it's all liquid, and taxation is also very simple. It comes under I mean, it's highly regulated. If you see yesterday also, Mr. Anand Narayan also spoke about it, that everything is FNO is now becoming like a gamble, and you're seeing a lot of activities taking place, highly regulated. So the regulators' eyes are always on this. So I would say in terms of riskiest, real estate, then equity, and then gold. Why has SGB fallen so much? Duty came off. Your duty now is import duty is only 6%. So gold got repriced. And I think there was something that came out yesterday that said, give me a minute, that the RBI is going to they're setting the redemption price also for the ones that they issued in 2016. That is somewhere at 6,938 rupees per gram, and the bonds that were issued on August 5th, 2016, they were at a price of 3,119 rupees per gram. So that is a 122% gain for the investors. So it's not that it's a bad thing, but SGB gets locked in. That's the only problem. But you still get paid for 2.5% is what you get as interest. But unless and until you don't want it to be locked, then you need to go towards liquid gold, that is more on the ETF side or the mutual fund side. But if you're not having any constraint on time horizon, you want to anyways use this in the future, SGB works fine for you. Yeah? When is the right time to exercise the ESOP on allotment or wait for the correction of stock? Here, I've put it in this slide. So when does RSU make sense? When? As in, if you can just be a little more elaborate with the question. When to sell? See, I mean, right, when the fundamentals are, so let's say, for example, a company is doing extremely well, stock price is also reflecting it, then you make use of it. See, I would always say that there's a bias when things are doing very well. You say that no, from here further on, things are going to do extremely well. And then you speak to people on the inside and they say, yeah, the stock price is not reflecting. It's going to go through the roof. You just see this quarter, you see the next one. That's a bias. Uh, you need to uh, consider the fact that valuations are a function of a lot of participants, but somebody on the inside will always be more bullish than somebody of that on the outside. Right, so you need to be little cognizant of that. That bullishness is not warranted for. So you need to be the better judge of that. I would only say that when you see that valuations are when the fundamentals have peaked, valuations also have sort of peaked. That's one time where you can sort of take advantage. RSU ka slide. I think there's only this one. I would only say this, yeah. On the inside, there's a bias for bullishness. Please tell about gold and silver ETF. See, gold and silver, they always work when there is a scenario that high inflation persists, and there's a lot of macro issues that are taking place. So we are right in that part where there is a problem. I've done this topic, gold and silver. I've done this topic, I think, 2 more times or 3 times. I have done this. One I've done it for Sphere, and the other 2 I've done for Milestones to Wealth, where the whole idea is that there's not a lot of supply on the gold side. On the silver side, it's difficult to mine gold. And so whatever is there above ground is all that's there, is all that's getting circulated. And the fact that you have to treat this as an alternate currency. You cannot treat this compared to equity or debt. You have to treat this as an alternate to currency. Why it's an alternate to currency? Because it used to be pegged. All currencies used to be pegged to gold. Then the gold standard. Every currency came off the gold standard, and ever since then we've had a debt bubble. So as and when macro scenarios start getting worse, you will see a lot more problems coming, and naturally gold, your precious metals, need to be revalued and repriced, right? So that's where gold and silver does come in. So as a part of your portfolio, you need to have some bit of gold and silver. So if you want to know how much we should do for you, just reach out to us on this number. Yeah, reach out to us on this number based on your risk appetite, based on your risk profile, based on your goals. We can help you and get you started on gold and silver. But the point is that you need to treat this as an alternate currency. And this is a very big hedge towards inflation, towards all macro situations that are coming up. There's a war going on. We are in the midst of a war. There can be another war come up. US is on the verge of a slowdown leading into a recession. So things are definitely not looking as great as what it should be. What is the import duty for silver now? Same thing for precious metals, about 6%. So what is our return on Sphere? So here is our return on Sphere. So if you see, our benchmark is the multi-asset benchmark. Post-tax returns would differ based on the individual, because legacy ones would have a higher gain. So post-tax returns would be different. But I think from our internal calculations of how much tax they are, I think the individual might be paying on long term plus debt plus everything is somewhere between 13.75 or something. So but we cannot peg like that. We are only seeing from an overall perspective. So our benchmark is multi-asset index. So we try to also benchmark ourselves to the next best options available, which is a flexi cap mutual fund. and dynamic asset mutual funds outside. So this is an average of all the flexi cap funds return and the dynamic asset allocation returns, which is your hybrids and your balanced advantages are all of it. Yes, Sphere is a PMS scheme. It's a PMS strategy. It's a multi-asset strategy where minimum investment is 50 lakhs because it comes under SEBI. So SEBI's norm says that for a PMS strategy, 50 lakhs is the starting point. Yeah, you raised your hand. I don't know if I can give you mic access, but you can put your question in the chat box. Poppy, can we do mic access? Check. Okay, Mr. Prash, I'm giving you mic access. So you raised your hand. Tell me.
Yeah, hi, thanks. I was not able to see the chat window. I mean, I don't know. I
No
just
problem.
the browser. So this whatever you've shown here, the FlexiCap mutual fund DA, it's not. I mean, it's any general FlexiCap averaged
No, it's
out.
the average of the universe.
Okay.
It's the average returns of all the FlexiCap funds.
Okay, so if you take any single one, it could possibly be much lower.
It will be, yeah, it can be within that range. Can be lower, can be higher also.
Okay. Sphere is actually small cap or mid.
No. Vriddhi is small cap. True Blue is large cap. Solitaire is flexi cap. Sphere is multi-asset.
Oh, that's why you're giving this number. Okay. Fine.
Yeah, Sphere is multi-asset. So when we compare ourselves to how do we do compared to a pure equity fund, right? Where they are overweight on equity, right? Where they have 80-85% on the equity side. We wanted to do that study also to see if multi-asset, the strategy that we are currently following, is actually doing much better than theirs or not. So that's why we compared to see, and it actually is doing well. We have seen 1 month or 2 months also somewhere where there is a, we don't like to see 1 month, 2 months, but to see, okay, what is happening, because there might be some months where our allocation towards equity might not be very high. So we understand that, yeah, the debt component has gone up, the precious metal component has gone up. So naturally, and we are building assets on the equity side. So we don't buy, or we don't do it all on one day. Let's say if you do start off with 50 lakhs in a day, or say today or tomorrow, that doesn't get depleted within the first day. So it's not a model portfolio. So based on that opportunities, when we start buying, usually it takes 7 to 8 months for us to deplete the whole thing, unless there's a very big opportunity. So when we started off, we got one opportunity in June. I think it was somewhere around 21 side. 20, yeah. That time our invested allocation was 95%.
Okay.
Right now we are at 40.
Okay. So maybe you start with 40 and then slowly staggered manner reach.
Yeah, staggered in and staggered out is what we do.
Okay. And that applies for just Sphere or
no, it's a house. It's a philosophy of the house.
Okay.
So whether it is whether we do it via mutual funds or whether we do it via equity, whether we do it, so we do a staggered approach. See, on debt, debt won't give you an approach for staggered, for example, because when yields drop fast, or when it gives you an opportunity, that time our aggression majorly comes from how much we want to buy, but we're very conservative on what we want to buy and how much we want to pay for that particular business.
Okay. So now is debt still a good one? I think debt is
Yeah.
also taxed at a higher rate, right? So it's still
No, debt is still good. Debt is still a very good opportunity. So arbitrage is also a very good opportunity. Arbitrage for short-term liquid, right? If you have something that's parked in your bank for for short term, I think arbitrage makes sense. It's tax efficient also.
okay. How do you? I mean, through you, or how does it this arbitrage pick selection actually work? You mean arbitrage as a fund? Choose those
Yeah.
ones?
Yeah, arbitrage as a fund.
Okay.
So if we do want to do arbitrage, just send us a hi on that number and just write your particular requirement, and then somebody from the team will get in touch with you and get you started. Do something that's good for you.
Okay. Okay.
But if you want to stick to the PMS is 50 lakhs.
Yeah, and okay, so this one has a minimum. How much is the minimum in this sphere?
50 lakhs across all PMSs in India. 50 lakhs is the minimum.
Okay, so this is also part of, though a mutual fund will still come under that category.
Yeah. So the thing is, if you just want to stick to, you don't want a PMS, right? You want to start your wealth creation journey, but you don't have 50 lakhs to invest. That's okay. We can just do for you on the mutual fund side where it doesn't come under PMS for you. So it will come under another. So the mutual fund distribution arm that will take care of that particular money. So there's no minimum investment for that. There's no fees also for that. It's regular plan.
Yeah, got it. I understand. Another thing is, so when we get PMS and people put the money, and it makes a lot of sense on you staggering it in deployment, but then this quarterly it will return back to the bank account, right? So you again need to replenish every.
No. We will use it in cash. So we will put it in liquid, or we will put it in alternates to cash. That's it.
Okay, so you will have an alternate till the point.
Yeah.
Which does not deplete in value.
Which does not deplete in value. It'll be in liquid.
Okay, got it. Okay, fine. And I joined a bit late. These slides, will they be shared, or I mean,
it will come on YouTube. Don't worry.
Okay, it will be there. Okay, got it.
Yeah. You see it on YouTube on the ithoughtpms page.
Yeah, that's how I registered. Yeah, thank you. Yeah, please go ahead. Thank you so much.
Done. Thank you so much. Is it possible to switch from sphere to Vidri after a few years? Don't do that. Don't shift. You should that ruins discipline. Don't shift. See, because today when we say we want to build something, and our investment horizon itself that the asset that we're building for is 5 to 7 years plus, right? Because we are trying to manage only retirement money, right? So it doesn't make sense itself for you to go from one to the other to the other to the other. It disrupts the whole thing, because they will take based on their philosophy, based on small caps market condition, based on valuations, they will have to deploy at a particular pace, right? So it disrupts the whole thing. So don't do that. How you want to do a basket of both? Very happy. Where we can have aggression on coming in on the small cap side. Here we manage moderately aggressively or conservatively on the sphere side. What is the cost structure in PMS? I mean, TER in MF is capped at 2.5% upper limit. Likewise, what is it for PMS? Today, everybody is going and doing NFO. Okay. NFO ka expense ratio is very high because it's a new fund, right? One, it's a new fund. Second, it's a small fund, right? Large ones will be able to gather somewhere between 6,000, 6,500 crores or 7,000 crores for that matter. Still, the expense ratio will be somewhat on the higher side, right? But for us, we've kept a 1.5% fixed fee on two of the products, which is multi-cap one, which is solitaire, and Sphere. And Sphere doesn't even have an exit load. Right? Solitaire has an exit load for the first 3 years, 3, 2, and then 1. Right? Large cap and small cap is variable, so they will have a variable component that comes in, right? But here we have kept things very simple, and we've kept it at 1.5%, which is very comparable to a direct mutual fund, where let's say so today our AUM is somewhere between 480 crores on the Sphere side. So for a 480 crore fund, your expense ratio for a mutual fund will be very high, but here we have not kept it that. Our entire philosophy is that we don't want to keep products, the cost of the product extremely high. It's meant for scale. We want to manage more and more money. Plus, each and every time you guys sell stock, we have to bear the cost. Yeah. That's true for any PMS. Our turnover rate is somewhere since inception, which is 4 years, is 32, 33%. So we don't buy and sell much. So we don't sell much. We only keep buying. And all the cost that's there, everything will sort of come to you. There's a proper report for capital gains that comes from our side to you. So your headache is little lesser. Right? Our sales on Sphere does not come up until either the valuation has gone through the roof, or there is some sort of a goal that is being met for you. So where something is coming, you have to rebalance for you. You have to do something for you, basically. That's something that you have to fund for. With that time, we have no choice but to sell something off. But since our inception, our turnover rate is very low. Thank you so much for spending time on a Saturday morning. It's 11, so I think if there's no further question, we can close. I'll put the number here. Please do take this number. Just send us a hi and with your requirement, and then our team will get in touch with you. But in PMS, can there be asset allocation? Yeah, definitely there can be asset allocation. Sphere is asset allocation only. Mandate is asset allocation, so mandate is asset allocation here. Dynamic asset allocation. And Solitaire mandate is multi-cap, so they have a separate mandate, small cap separate mandate, large cap separate mandate. So thank you all for joining in. Have a great Saturday ahead.